Hi, my name's Paul Mulder. I am the Managing Director of Pacific Lime and Cement. My company is an industrial building materials conglomerate based in Papua New Guinea. We are looking to service the needs of all of PNG's industrial building needs and stop imports, and also establish an export industry at the same time.
Paul, thanks for joining us on the show. We're going to dive into the kind of commercial realities of where you're at, but maybe let's start off with a bit about you. Where are you from? What have you done relevant to what you're doing today?
I've been in resources 30 years, getting old, and I've worked in the steel, iron ore, coal sectors. Spent a fair bit of time in early part of to mid part of my career, 15 years in BHP, steel mills, coal mines, iron ore mines. Spent a time with private equity with KKR. Then I left and went and ran Gina Rinehart's energy and infrastructure assets as the managing director. Built a asset, prosecuted a transaction, circa 1.26 billion USD. We sold the assets for, but everything from concept all the way through to definitive feasibility studies and ready for financial investment decision. After that, I decided I've done this a lot. I'm going to back myself. Founded Maya Resources, which has subsequently been listed and renamed as Pacific Lime and Cement. So essentially the original founder, been in the MD space for 10 years, running the company, and now we're fully funded with phase one ready to go.
Fantastic. Well, nice introduction to you. And we'll talk about your team in a second, but I think there's a few variables here that people may not know much about. Firstly, PNG, in terms of operating in PNG, what's that like?
Look, I think in any country, it depends upon what area you're looking at operating in. When we looked at the opportunity in PNG, we looked for coastal area, easy for development, easy for operations. So our area, in fact, if you're looking in PNG, it's coastal, resources at surface sticks out of the ground 150 metres, 400 million tonnes of high-grade resource there. So from our perspective, it's a good opportunity. PNG as a country, it's a developing country. With all developing countries come their challenges, but also their opportunities. We're very happy with our investment there. We're part of the furniture relief. Government support us, landowners support us, the industry supports us, and the Australian government supports us in what we're trying to do. For PNG, depending upon what industry and what you're trying to do, will depend upon the experience you're going to have. We're in a country that desperately needs bulk commodities and downstream processing. They don't have any cement and lime integrated of their own at all for their whole country, for 10 million, 11 million people. So we like that thematic being in PNG because it services a domestic need, and it also then creates large opportunity for exports into the Pacific and Australia, who are importing as far away from North Asia. So we really like it. We love the country. We love the people. We've been there a long time. As I said, well over 10 years in developing project.
So, I mean, just explain the kind of end use case sectors for lime in PNG. And you talked about export as well. So I assume that will mean Australia or the wider Asia Pacific region.
Yeah, so I think people would sometimes get the terminology confused. So you have limestone, the raw material. Then you have quicklime, which is essentially, it's a different material altogether. It's a chemically different product. It's a chemical neutralizing agent. So you take a low product, $10 a tonne or whatever it's cost for limestone, to something well north of $100 a tonne after you've gone through the downstream manufacturing, calcining process. So once you've done that with lime, it's a very environmental product when you think about what it goes into. So it goes into the neutralisation industries in the copper gold sector, in the nickel sector. If you look at, or when you talk about the transition to renewable energy or battery metals, all battery metals in some way, shape or form ideally should be using and do use quicklime. The higher the level of battery metals, the higher use of quicklime consumption. But it doesn't stop there. It gets used in desulfurization of smokestacks. It gets used in the purification of water. It gets used in road stabilization. Just to name a few, there's many other uses that quicklime has. So when you're thinking about sectors that you support, when the economy's down and gold's roaring, quicklime's benefiting, because the more gold, the more quicklime you consume. When everything's amazing and gold's depressed and there's money flooding everywhere and everyone is punching into batteries and solar and everything, quicklime's being used. And when both of those two sectors have areas have, or thematics have problems, the government is putting stimulus in, which is road building and construction. And again, quicklime's a benefactor. So we're very comfortable with the thematic around that.
Right. And so do you have a sense of the size of the market in PNG? I know you're talking about, exports as well, but the size of the market in PNG in a, growing economy, and how you insert yourself into that space. I mean, where are you today?
So I think to answer that question, one has to understand where is the market in PNG at. So in PNG, the likes of the large gold miners and nickel producers are all importing out of Malaysia, Thailand, Vietnam, etc. Their lime. So inserting yourself into the market is really providing the market a couple of things. You're providing the market a product that is as good quality, if not higher, in grade. You're providing buy local support that companies are signed up to in PNG in their agreements with the government to support local industry as long as you compete on price and quality, which we can and do. And then I guess when you look at the other factors around import replacement, when someone is literally thousands of kilometres closer to buy from you and they're buying from their own country, it doesn't make any sense to buy from abroad. So the way we see it as a first mover, by us having demonstrated after 10 long years of going through every single step, from an idea all the way through concept, pre-fees, bankable, and now in construction, having achieved a financial investment decision, that's a key for us. It takes time, it takes effort, and as resource developers know, you might develop something for $100 million or $1 billion. You still got to go through the same processes. When you're a publicly listed company, there's no shortcuts. So we've got to, from our perspective, we're very conscious that how long it does take to do a good job, to tick off all your ESG requirements and be a good corporate citizen, as well as being competitive and having the landowners and government alongside you. So that takes time. So we believe, based on that and based on all of the others importing, we're ideally situated now to see the majority, if not 100% of imports now be displaced, and we provide that full requirement of quicklime. Now, I think quicklime, it being available locally, will also stimulate growth, but just in the demand that we have locally now in PNG, that's around 250 to 300,000 tonnes. That's circa 70%, 75% of our productive capacity for the first two kilns we've got slated, and that's without any of the growth projects coming on or any existing projects expanding. And there's talk of many of those expanding, which would see more than 100% of our phase one productive capacity just taken up by domestic demand before we send even 1 tonne offshore.
But how do you compete on that? To displace this kind of overseas, these imports, is it purely based on price? Is there some sort of incentive for you, or even kind of tax credit from governments to incentivize the mines in country, and other sectors that may be using your product? How do you win quickly, I guess is what I'm trying to get to.
So I think it all comes down to how, when you're looking at any product entering the market, you have to ask yourself the question, why are they going to buy from you? Why won't they just stick with what they're currently doing? It's easier. Is it cheaper? Is it more convenient? Is there legal requirements, etc.? I think the first thing that my general advice and view to my team was, if we can provide a product that stands on its own 2 feet with regard to its ability to move forward based on its technical parameters, it'll be well regarded by the market. And what I mean by that, and if I can just draw a comparison, our competitors are 200 kilometres inland in Southeast Asia. We are on the coast next to an $18 billion LNG facility, 24 kilometres from Port Moresby. The LNG facility is several kilometres from our site, and there's an expansion going there. Our resource sticks out of the ground, like I said, 140, 150 metres. It's ultra high grade with zero strip ratio. And our distance from our quarry to our wharf is about 800 metres, not 200 kilometres. And then you overlay, we're right on the domestic door of the Port Moresby market, but all around PNG, we're 75% closer than the other importers with regard to freight distance. So when you look at the logistics supply chain, and that's what lime is, it's a big logistics supply chain game, I feel that those merits on themselves are very compelling. But in addition to that, the government definitely has come to the party. They know that they are competing for capital in Southeast Asia as it grows. It's going to be the engine room of the global economy for the next couple of decades at least. And then so when you look at that, there's a competition for capital. Why is someone going to come to PNG and not to Malaysia, not to the Philippines, not to Thailand? What is PNG government doing? So they've really embraced special economic zones where you're downstream processing and value adding. So we're the first actually to have an industrial downstream special economic zone in our name. And as long as we're downstream processing mined product, so as long as we're taking a raw resource and then downstream processing and value adding, displacing the imports, creating jobs locally and selling locally first and meeting the requirements first, the government are very supportive in that. That comes with fiscal regimes, and what I mean by that is tax relief, 10 to 15 years, corporate tax relief, other import duty reliefs, etc., etc. I give that backdrop on with the guys that you're competing in China, Philippines, and Malaysia, and those sorts of countries where combined they've got 1,500, 2,000 special economic zones that have been granted. So that sort of capital's flowing into those hubs, and the PNG government has actually worked quite well in understanding what levers can we pull to attract investment dollars. And they've done that. And look, for us, we had the market respond accordingly when we recently raised capital for what would be seen as, frankly, a pretty well unprecedented raise on the Australian stock market for a building materials company, greenfield in PNG, that's now well under construction.
So it sounds like you can sort of undercut the landed cost price of lime coming in because of all the factors you've just outlaid. How do you just think about the quality of the material you're producing? You know, in the market, do they generally pay higher prices for better quality in terms of reactivity or impurities, etc.?
They do. So the higher the grade, what they term value in use, but typically higher the grade, and it's been if you look at the last sort of 5 years plus, maybe even 10 years actually, but 5 years plus, there's been a flight to quality. And so if you look at Western Australia, used to be solely, or not solely, but largely supported by the locals such as Adelaide Brighton, that has recently been bought out. So when you look at that, and you look at that metric, and you say, well, why are they losing market share? It's because the flight to quality is occurring. There's been those in Thailand and Malaysia, even though they're 200 k's inland, are still able to transport and ship higher grade product to customers who prefer that product in a competitive way.
Right. Okay. And what about pricing? Because obviously, like if you're operating in a lowest quartile or lowest decile production cost, that's great. But at the same time, you want the kind of predictability of understanding what your margins will be. So how stable has the lime market been historically?
So look, the lime market doesn't come off an index. It comes off its private treaty, and it's negotiated contract to contract. And so I think really your competitive advantage is how competitive are you to your next best alternative? The customer's next best alternative. how do you make that competitive? And then once you're set up and running in PNG, obviously, there's the big corporations are very committed to servicing locals. So on the basis you can say, hey, look, I can be just as cost effective by you supporting local, which keeps all the jobs here, which keeps the products here, which also reduces and supports your overall inventory and supply chain responsiveness, etc. All of those things, they all play a part in that assessment of making sure you keep that competitive edge.
And in terms of the different markets, we talk about PNG, obviously great need there, and lots being imported. Are the buyers there prepared to pay the same sorts of prices as WA? And could WA actually be a higher margin despite the transportation costs of than PNG?
Well, I think what you've hit the nail on the head on is transportation charges. So at the end of the day, you've got to look at what is your competitive advantage to your market. So when you look at where PNG sits to East Coast Australia, Darwin, and then West Coast Australia, we're going to have a certain freight element. But once we get to the coastline, it normalises. So when Thai, Malaysian, Papua New Guinean product gets to the coast, it normalises to a certain extent because it depends upon how you've delivered it to those coastlines. Have you delivered that in a box? Have you delivered it in a bag in a box? Have you delivered it in a bag in a ship? So there's those sorts of other considerations. So it's not as simple as the price will be more competitive or less competitive. I think if we optimise our supply chain, which was what we're doing, we're here, frankly, to upset the apple cart for what is the existing users in the market. We're looking to do things differently. We're looking to enter ports differently, work with those ports on long-term solutions, which we're doing. So I think depending upon the customer's requirements, and you've got to appreciate you've got very, very large customers that essentially could almost take 100% of all of our first two kilns, just one single customer in WA, versus smaller customers. They'll have different price points and they're willing to pay different prices for different levels of certainty. Like if you say, I'm going to provide you a product, but it's 800 metres from the port, and I'll carry insurance stock for you, and my supply chain can turn around within X days, and I'm coming through your preferred port and through your preferred delivery method, people will pay a premium for that.
Right, and with regards to competition, obviously PNG, there's imports coming in from Malaysia, Thailand, etc. Australia too, I suspect. So,
correct.
What is your kind of model in terms of wholesale? Do you sell direct to end users, or is it better through traders? I mean, and what are you set up to do today?
At the moment, we're set up to sell directly to the customers. And we do that because I think at the end of the day, the customers are very clear on what they want and what they need. And Lime isn't just buying like a widget. It's quite, they're quite technical. So when you look at their procurement teams, they're very educated with their Mets on, hey, this is the type of lime we need, this is when we need it, this is how it could or couldn't blend. So they're the sorts of things we like to deal directly with the customer on.
Okay, and okay, I didn't realise the technical component of it. I kind of would think of complex metals like lithium, etc., and having to test that. But when you're talking, you mentioned earlier these are kind of more contractual based rather than sort of market pricing based. So do customers switch suppliers quickly? Do they prefer long-term supply contracts? If so, what does that look like? I mean, how do you get the kind of long-term security? How do your funders get the long-term comfort that the pricing is fixed?
Yeah, so I think it's through long-term offtake agreements. And when I say long-term, anything sort of 3 to 5 years is the offtake agreement. I guess one of the benefits that mightn't have come across clear when I first introduced the company is we don't have debt. So we're equity funded. So we do have some additional levels of flexibility presently in how we contract. So I think that I see as a benefit. However, I think as we move forward, irrespective of how the funding comes through, the end users just want to make sure that one, they have a stable source of supply, and so that goes to your point about how long are these things, how often. You're not switching quicklime suppliers every week or every second week or even every 3 months, right? It's people because it's what other people don't realise is quicklime is, as a reagent or as a neutralising agent, it's extremely critical to production. If you don't have quicklime, you can severely impact productivity. So relatively unknown, unseen, unheard of commodity in the sexy world of nickel, cobalt, rare earths, lithium, but at the back end of every single one of those is quicklime.
Okay, you referenced the technical nature of the product quality and the product production. What do your potential off-takers and buyers look for from you?
So obviously the first one, price. Everyone's price conscious, but in saying that, it depends upon the specific process. If you're looking alumina versus gold versus water treatment versus road stabilisation, the specification of each one of those different usages carries with it different requirements. So, the silica content, if it's too high, won't be accepted in the alumina sector, as an example. So there's those sorts of things that you need to. The technical specification of your product can be tweaked from the grain size, from the product size, also to the chemical assay elements that you present as your product. You can present a high-grade product, a medium-grade product. It depends upon how you mine that product, how you put it in the kiln. There's flexibility depending upon the stone size that you put into the kilns as to what you're targeting to get out of those kilns. And then indeed, whether or not you stay with quicklime, or if you look at what we've got on our plant, we've also got hydration. So you add water in a controlled environment, and you have hydrated lime that commands a lot higher premium. So some people will want that hydration, some people want the quicklime. But what people may not be aware, unlike limestone, quicklime, if you add water to it, it's an exothermic reaction, and you mentioned the word reactivity before. How quickly water can get to a very, very hot temperature, over what speed and time you see. You can pour water, just normal water, onto quicklime, and you'll see it boiling and bubbling within the space of 10, 15 seconds.
Like in terms of these, sticking with potential customers, in terms of these sort of long-term offtake commitments, how many of those do you think you need? I mean, what percentage of your production do you need to commit to before you can, or do you need committed, I should say, before you can actually reach, first production? Because you're going to need to give a surety to the funders that you got enough revenue coming in for a 5-year term contract, and what do you expose to the kind of spot market, as it were?
So I think probably just going back to what I was mentioning before, our funders are equity funded. So we've got equity funds that have been put forward, and that's sufficient to construct phase one, being the 2 quicklime kilns and all the associated infrastructure, being the wharf, the power plant, the roads, camps, the quarries, etc. So all of those respective items. So we've already got the approval from them, because they've had a look and they understand, and particularly the board, I would say, understand what and where we are at with customers and how we're progressing with customers. And based on that progression, we've taken the decision to go into production with the highest level of confidence that we're going to have more than enough market to justify undertaking this investment.
And are you sticking with quicklime? I mean, can you expand into cement or clinker, or whether that be in PNG or elsewhere?
So look, our project is actually two stages. So we've actually set up to stage one is to do quicklime kilns, and that gets to expand. And I think one of the key things maybe for your viewers is if you look at the money we're spending to establish a greenfield asset and two quicklime kilns, when you double that capacity, when you go from 2 to 4, you don't put all of that greenfield infrastructure in again. That's an upfront cost that you don't have to duplicate. So the incremental capital cost to double production capacity, if you look at one of our recent presentations, it's very, very encouraging when you look at the additional incremental investment dollar you have to spend and what type of EBITDA return you get. It's a very, very healthy IRR. So when you look at that and you're saying, hey, I'm looking to be involved in a company that's got healthy IRR, but also even healthier growth prospects, we're it. So I think that's part of what we're doing with quicklime. But to answer your question, I just want for the viewers to be very clear. This project is a central cement and lime. So it's the quicklime and the clinker cement. We have 380 million tonnes of JORC resources plus that has been declared, published, announced. Around 200 million of those are a separate deposit right on the coast in our mining licence, in our special economic zone. That area is just for quicklime. Then you've got the second deposit still within the mining licence, still in the same area, with it circa another just shy of 200 million tonnes of material. Now that material is more suitable for cement. It's a marlia, lower grade, which is what you need for cement. You need the marls, the aluminosilicates, the iron corrective clays, etc. So we've got all of those constituent minerals on site. So you've got a special economic zone that will take from these quarries the raw products. The raw products, if they're not downstream processed, we don't get the fiscal benefit. If we do downstream process, we get the physical benefit. So what the logical step of progression here is we open the area up by connecting water, power, roads, bridge, wharf, all private, vertically integrated. Once that's been now done, quicklime kilns are there. We're moving and we're building. The government and ourselves are working heavily together now to establish the clinker and cement facility, which is fully permitted, approved, bank feasibility study. Everything's been done. But we're not saying we're going to wait till quicklime finished. We're saying we're going to move as fast as we can in parallel to get the clinker and cement running because it's a totally separate deposit. Yes, it may share a road and it may share a wharf in the future, but that's off the backdrop of PNG consumes 33 kilograms of cement per capita based on around 11 million people, 10 to 11 million people. Based upon that, you might say, well, is that good or bad? The developing world, Ethiopia, Afghanistan, you look at places like Kenya, India, all those Brazil, all those developing nations, their consumption per capita is 250 to 700 kilograms per capita. So there's a direct correlation between GDP per capita and cement consumption. So the government has very clearly articulated 60,000 kilometres of road, $55 billion of projects, US dollars of projects coming up in their pipeline over the next decade. All of that is going to need cement. Now the cement coming in that gets sold at the local hardware stores in bags, at the retail outlets for people to go and build their homes and do their things is very, very high. We've essentially, we have agreed with government that we will halve the retail price of cement in the country by sourcing local, by using local products, local people, local resources, and what we're terming the Rock to Road initiative is one that's taking the resources in the ground and evaluating and transforming them into cement that can be used by the population and by the PNG government, Department of Works and roads and buildings and bridges. But if, as I've said publicly, I've said this to the government as well, if you're going to do quicklime and cement, in a special economic zone that's encouraging downstream processing, that in fact rewards downstream processing. The landowners and ourselves have mobilised under joint venture together a structure where we'll further downstream and take the cement, concrete, batch plants and then into casting, so pipes, culverts, bridge beams, gutters, anything that builds a country. Why are you going to import that, or why are you going to be using imported product to make those products? You're not. In accord with what the government wants to see is high level of jobs created. You're going to go from quicklime, clinker cement, and then you're going to go into your downstream building materials products. So if you look at what Boral does, say as an example in Australia, it will be like a mini Boral, which may not be so mini. When you actually look at, we'll be the only ones in the country to start with doing this. We expect that there'll be 2, 3, 4 more that come up, but it will take some time for that to happen. We encourage that to happen because simply, to be frank, we don't have enough capacity to service the entire country's needs. When we reduce price, you're going to see demand elasticity go bang. Demand's going to go up. We're not going to have the ability with our resource to service all of the demand that will come for cement in PNG.
Sure. I mean, obviously, you're going to have to look at margin, not just output, because the bottom line is the thing that matters. Look, I want to go back to this kind of equity-only funding thing, given that you've got Appian's debt facility there. Look, you just talked about demand being there, government support being there, and then you spent 10 years making sure that you'll be a good citizen in all of this. Can you talk to things why the equity route makes more sense than getting debt in there? Because some of your shareholders say, well, hey, you're diluting us, you're giving away all of you're giving away too much of the company here. Are you doing pre-sales against this demand? Are you've got an 18-month build, you've got the first 2 kilns are going to have to ramp up as well. So you're probably 24 months out from the point where you start commissioning. Why does it make sense?
It'll be quicker than, it'll be circa the 18-month mark with quicklime kilns.
Right.
Unlike when you start them and you go, they just go. You're right.
Okay.
You got maybe a month to 6 weeks of commissioning.
Okay.
With these sorts of things. So, look, and I think we've gone equity only. The market, when we went to raise money, the market provided a lot more than what we'd expected to get. So we were able to raise more money on that basis, and looking at that, the money that we have raised, when we fast forward to where we are today, and when we did the raise, there's a number of things we were working with Appian on, and look, to be frank, Appian were great to work with. They're an excellent outfit. As you know, they're mining both debt and equity. However, where we got to ultimately, it was felt by the board and shareholders that where we are in relation to the development, where we are in relation to satisfying the things that they needed to be satisfied, and where we were as an organisation, we felt that it was best that we move forward in an equity-only manner. We were very fortunate that we raised more equity and were able to do that, and in concert with that, able to conduct a significant amount of value optimisation and restructuring with regard to costs and capital intensity, design, and those sorts of things that really have played to the strengths of the internal PNG team, who have done a lot of the self-perform rather than outsourcing to EPCMs and other contractors. And point in case is our wharf. You can look on the website and see stage 2 of the wharf is already built, and that was built in-house. It was built by our own self-perform team. So when we started looking at that and looking at ourselves and looking at that self-perform element, at the end of the day, the board had made a decision on the way it should go. And look, I feel that having spoken to numerous large shareholders since we announced at the start of this month with the PNG Prime Minister, the Governor and the local Member of Parliament, as well as very senior delegation of other senior ministers at that financial investment decision launch, I think we've definitely made the right call in this instance.
Okay. And can you just maybe elaborate on the capex optimization that you went through recently? What was that a factor of? Was the scope reduced? Was it redesigned? And what concerns do you have over managing construction risk in country when it comes to labour, supply chain, or cost inflation?
Yeah, so I think it was a bit of all of that. So if you look at the way in which and again, this is available on the website for anyone that's interested. There's actually a fairly comprehensive presentation that was released at the start of August that goes through essentially capital item by capital item in a waterfall of what was done, and then a sheet that explains what has been done. But the upshot is there was an opportunity to change the packaging strategy. So we significantly reduced the various contractual interfaces that we had down to 2 after probably more than 10. And that reduced construction execution risk significantly. And having the EPC provider, which is the licensee of Merz, the Swiss company, come on, and the licensee that's out of China that is now building our kilns for us, we're very, very confident in their capability, not just in kilns, but also in full quicklime plants. And with that competence, they've had other clients also get them to run the plant for the first 12 to 15 months throughout the defects liability period, which is what we've been undertaken with them as well. So when you actually look at that whole metrics where you say, okay, well, I don't have any debt covenants, and we've seen what's happened to some companies when they're late or there's been issues in raising capital when that happens. We don't have debt covenants that are restricting us. We have a refined scope with regard to construction interfaces. They've been totally reduced. We have a EPC construction contractor that's willing to back themselves to operate and guarantee the output and productivity of the plant 15 months until after they've actually built the plant, whilst in parallel training all the local Papua New Guineans to ensure that that they've got the jobs. So for that gives us a lot of comfort. Whenever a construction contractor is willing not to just walk away and operate what they've built, you're going to get a much more meticulous, or in my opinion anyway, much more meticulous job with regard to how it gets developed. I think it's what I call a better alignment. In relation to scope, there's been a number of optimisation opportunities that we've looked at, from everything from the quantum of earthworks we're doing, to the pads that we're clearing, to the roads, to the structural, mechanical and electrical reticulation around the site that's been largely compressed to optimise capital. And as these things evolve, someone say, well, why didn't you do that to start with? Projects, as things evolve, different people have different design ideas. We and I don't have the mortgage on all good ideas, that's for sure. So as these opportunities continue to percolate, we operate on the shareholders' best interests, and we make sure that we factor all that into the equation of developing this asset.
Okay, yeah, I like the EPC agreements. They're incentivized differently. I like that. With regards to the cash component at the moment, $80 million or so, will that be all for the construction, or is there working capital in there? And if there's not, will you be sort of taking up some PNG-based working capital facilities?
We have a number of different opportunities in front of us. One of what you've just mentioned, a PNG working capital overrun facility being made available if we wish to take that and draw from that. We've also got our own liquid assets that we can draw on, and we've also got the ability to prosecute rock sales. So stage 2 of the wharf is complete. So there's a number of different ways that the company can attract, well, not really attract, it's probably not the right word, can secure internally without having to go and do a capital raise in the market, is through an overrun facility, through its own liquidity, if it's other assets that are material in nature, as well as rock sales.
Okay. And I think there was mention of the government maybe coming in and taking an equity position as well. Would that be paid for?
Yeah, so that's yes, it would be. So that's actually another good point. So in relation to alternative, whilst it hasn't occurred, there's a definite indication, and it's more than an indication. There's a written position and ability for the landowners and also the PNG government to take a stake across the lime and cement assets, and indeed it's public. They've signalled that they're going to be doing that. So we're just working through that at that asset co level.
Okay, and can we just look at the potential? Look, there's a 2022 DFS and the 25 update. Can you give us a sense of the scale of this, the opportunity of this, with maybe like the cash flow for the first 5 years, given you're debt free at the moment, and what could that mean in terms of post production priorities with dividends, expansion capital, debt? How are you allocating capital?
There's a number of different aspects that I'll address here. So when you look at the 2022 aspect there, you've got EBITDA projections, and those EBITDA projections obviously then have to factor in over the stage or the life of the debt facility, principal and interest charges, which below the EBITDA line will significantly eat away at that free cash flow. In this scenario, with the selection of equity only, where we don't have that principal and interest draw on EBITDA, we've got a much higher level of free cash flow straight up, obviously. So we've got a couple of choices to work with here. We've outlined in the presentation at the start of August that we can utilise that free cash flow and expand. We can utilise that free cash flow and maybe we don't expand as much. We pass some of that back as dividends. At the end of the day, we're looking at what is going to reward shareholders for being invested in the company, number one. Number two, though, still give them the appetite for the growth projection and the opportunity for this company really to grow. We don't want to necessarily hamstring the company, we do not want to hamstring the company from growing. So I think there'll be a balance there between our free cash flows in the first 3 to 4 years, and how much we'll use of that to expand the assets. And look, at that time as well, as you'd probably more than appreciate, is once these things roll on, and look, even since the announcements happened, the parties that have approached us that want to talk to us about opportunities, etc., that's in the financing space. The type of financing they're talking about is more of a commercial bank loan, a lot lower rate, a lot less detailed with regard to covenants, probably cash backed in some instances rather than liens on assets and those sorts of things. So all of those considerations need to be balanced up of what's best for shareholders. And as the founder of the company, I argue that this for me is not a lifestyle job. This for me, I founded the company, and on that basis you can be assured I'm trying to make the best decision for you as a shareholder, but also myself as one of the major shareholders in the company. So I'm truly trying to do the right thing by the shareholders.
So let me try to understand what I'd be buying into. I now understand a little bit more about the lime cement market than I did at the beginning of this conversation. But in terms of the potential acquisitors of this, is it a big market? Is your location advantageous to those in terms of their jurisdictional coverage that they may be looking for, or is this just like an ATM machine, like a cash cow? Moving forward within a annuity stream of cash based on your PNG projections? How do you view this? What am I buying into?
I think you're buying into a cash cow that has the resources, the landowner government support and the fiscal regime to take some of the cash cow element to that and say, hey, by us investing and not paying that as a dividend, by me putting that back into the company, our return by putting that back will come back several fold, so that you're buying into a cash cow growth asset.
Okay, interesting.
Because at the end of the day, as the board needs to ultimately make a decision, how do we grow the company to a material level? So if you're looking at some of the projections, and they're public, but if you look at some of the projections, this is 150, 200 million dollars in EBITDA. When you start looking at those projections, and then you start to apply a building materials resource, a building materials, not a resources multiple, like if you're a Boral or an Adelaide Brighton or those sorts of things, it's a lot bigger market cap company than it is today. So our objective is to recognise shareholders along the way and appreciate them to the level that they're comfortable and they feel, yep, but we still want you to keep growing the company. We want you to get to that, that multiple, and the sort of the 200 million target that you've got. Keep moving forward with that in a way that's balanced.
Right. I mean, you hit upon something there, which is obviously demand forecasting, and I guess from earlier, maybe logistics efficiency. How do you help us, or how do you guide future scale of opportunities, as you just outlined? Maybe you want to reinvest. So reinvest into what? You've got the PNG market, which looks ripe there for the taking, as it were. You've got to break into other markets with competitors also trying to do the same thing. How do you stay on top of this growth profile that you're intimating here?
So I think when you look at the resource base that we've got, and then you look at the growth opportunity and the product diversity from quicklime to cement down to building products, and you look at the how PNG has not been, it's not a developed country. 86% of the people are in the dark still. There is huge infrastructure development to occur within Papua New Guinea, massive. And then you say, well, how do we working with the government to? They understand, if you're going to develop this, how can you get certainty? Like, how do you credit wrap future development and demand? If we've got this project, this road, this infrastructure hub, how does that all come together? And that's what we're working on at the moment, to make sure that the government and ourselves and the landowners are all aligned, and which we're very confident of, hence the support we've already got, and the relationship we've got. So I think that for us, our commitment is we will, if you look at the Australian market and you say, well, I'm 2 days sail to Brisbane, 5 days to Sydney and 7 days to Melbourne, and my competitor's 19 days sail away. And say, well, do I want to break into that market? Well, yeah, I'll break into that market. I'll take care of Papua New Guinea and the huge demand centre that's there. I'll break into that market because I've got a massive freight advantage. And why would I take all the investment risk of cement, clinker, and all of the thing coming down, and then just sell cement to someone in Australia? We wouldn't do it. We would do exactly what we're doing in PNG. We would take the cement, we'd set up our own hubs on the east coast of Australia as an example, and we would downstream process into concrete and batch plants, etc. The margins for concrete and cast products in Australia are extremely healthy.
Okay. And you mentioned earlier access to, I guess, other liquid assets, semi-liquid assets, Oracolo Bay Industrial Sands, the Adderton Resources stock, etc. Can you sort of talk about that part of the balance sheet?
Yeah, so look, I think you've got Oracolo Bay Mineral Sands project, that it's not a huge project. It's 25 million capex. We're working through the development phase at the moment. Announcements have been made in relation to that, and we're working on that project as we speak. You're going to have cash flows coming from that when that comes into operation. You've got, as you pointed out, Adderton Resources has got some extremely prospective ground and opportunities. We've got 50 million share stake in that company, with material stake. It used to actually be under our umbrella, and spun that out because at that point in time, those type of copper gold assets was not core to us. Hence, we focused our attentions on the lime and cement, hence our name. Not to say that other opportunities don't and won't come along; they will. But for us, we see that giving us the comfort that the company has access to liquid cash assets or cash flows coming up across those two classes that you've mentioned.
You've got the renewables in there as well.
Yeah, and look for the renewables for us is something that we're very passionate about, and it hasn't been easy, but the people need it. The government wants it. There's a huge resource being their forest that can be saved over there from being logged, but it doesn't stop there. You can offset through carbon and prevented deforestation, but also solar and wind and geothermal. Now, a lot of people talk about that, but from our perspective, we've got a solar site that we've got within our special economic zone. There's an ability to move to that, but I think what we're trying to do is people don't get confused. We're Pacific Lime and Cement. Our focus is to deliver quick lime. We're under construction. We'll expand that as fast as possible into cement. That as published, can add another 95 million of EBITDA, and then move down into the cement, the concrete and the cast products, etc. And supporting that, obviously, as you're building that precinct out, renewable energy comes in. If you can get carbon credits to offset that and become more of an environmentally offset based precinct, that we're going to try as best we can. We're going to do that, and that's obviously subject to the projects getting up, but that's our intention.
Okay, so it's your lime and cement focus, but the access to capital means that you're not having to think anytime soon about offloading some of these other balance sheet items. Okay.
Look, where we're at the moment is, look, we've got the money to build, so we're off and building. At the same time, we have access to, as you pointed out, an overrun facility. Should we choose to draw on that overrun facility, and then you'd look at that and say, well, do you still need more cash? If you did, we've still got, as I said, rock sales. We've still got other liquid assets that we've just spoken about that we could work on. My objective is to not go back to the capital markets. I don't want to go back and do raises when we don't need to, because we're funded internally. We've taken the dilution, the shareholders have taken the dilution to actually get something up and running that can produce cash flow. And that's what we're comfortable with.
Okay, and you have mentioned your relationship with the PNG government, Papua New Guinea government. Where are you with the kind of the CDA, the Community Development Agreement with the National Executive?
So the National Executive, the NEC, as they call it, we have presented to them with the government, and that has been endorsed, and we're moving forward. But when the documents are finalised, that's when we'll be able to make the announcement. So we're working on that as expediently as we can. Just to be very clear to the viewers, the CDA had mining, labour, treasury, commerce, the landowners, the provincial government, local level government, local member of parliament, Mineral Resources Authority, State Solicitor's Office. So it's a very detailed process.
Right. Okay.
The document's been agreed and initialed. And
so the landowners have agreed as well.
Correct.
You mentioned that. Correct. Okay, fine.
That's been agreed, and it's literally up with NEC. That's been endorsed. We're just waiting for the overall paperwork to come back down and the final arrangements to be signed.
Okay, and obviously you'll be hiring local and all of that kind of good stuff. What are the kind of the benefits, or what are the agreements with the community in terms of what they get out of this?
The community has had a relationship with us for, like I said, I've been on the project 10 years. So we see ourselves as very well partnered with them in a number of different ways. So just at the top, what they're going to get is this area doesn't have access to a road. So you've got over 1,000 people that need to get into banana boats going into the open ocean to get to just across into the next village, the Lele village. And so we're going to bring roads, bridges, power and water. They don't have water and they don't have power either. So they're the first benefits, level of benefits. The second level of benefits are the landowners are going to get direct jobs. So we've got a commitment that how we employ, and if they're qualified or if there's a competency gap, how they're trained. And there's a formal plan with the Department of Commerce and Industry and the Labor Department that articulates an agreement. So they'll get direct employment. There's no jobs there. The third level of benefit then is the spin-off businesses. So the spin-off businesses are the things that they can be supported on. So if you look at construction, civil, road maintenance, catering, security, the list goes on. Those sorts of spin-off businesses. Now, it all sounds good and well, but I want to be very clear, viewers. When you look at what we've done all the genealogical studies, we've done all the social mapping, we've done all the baseline studies. You've looked at all the compensation agreements. We've given the landowners, because they couldn't afford it, we gave them their own lawyers at their choice, as long as the scope was acceptable to us, which we've reviewed it and said, as long as they're going to represent you fairly, we'll pay the bills. We want to be seen as partners. We're not trying to do anything that's untoward. You get your own lawyer, we'll pay for it. So the lawyers have sat across from us. We've talked and worked out all the agreements together. And our commitment was, you hold us accountable for what we said we're going to do. And so they're very comfortable, and hence why we've had such positive media and press. This is a long-term partnership. So in doing that, what we've done is we've set up all their incorporated business groups as clans. Those clan heads then have a head company. We've mobilised that company, we've set it up, constitution, shareholders agreements, all of that's been set up along the way for them. We've then at FID provided around 2.7 million kina, about 1.3 kina, a little bit more than 1.3 million kina each. For your viewers, it's around $600,000 Australian dollars. But so that's just to get them going. But then the spin-off businesses that I've spoken about, we've set up structures so that they get free carried into the spin-off businesses, because they don't have money to go and buy the diggers and the excavators and the trucks and the equipment, and they don't have the IP and the services, generally speaking. So we've said, look, we'll free carry you, and we'll make sure over a period of time that ultimately you're not only a shareholder, you're the largest shareholder in the company, but you haven't had to pay for it. You get to work into that. So we're putting meat on the bone here. You've asked what benefits are there for the shareholders. And then in the in the special economic zone business, the downstream businesses as well, post the lime and cement, we've actually given the landowners a free carry into that, a 50% free carry and a veto right on their land. And what does that mean? It means that we can talk about doing all of these things. We'll free carry them 50% on the development of that land, and they still have the veto right to say no. So from an ESG point of view, if you're looking at the overall, these European and UK and US based companies that really are stringent on these sorts of ESG requirements, we believe we've done extremely well in enabling that to happen. And finally, but not least, we've also given the landowners free carried equity into the subsidiary project level with an opportunity also to buy in with the government.
And so, okay, so there's a lot going on there, a lot of involved, and I hope everyone engages with that. And just back to this, the CDA briefly. Does it include the environmental safeguarding components? Things like, I think you've talked about forestry carbon credits at the Camilo Doslo project, etc. Is that all kind of jammed into the same document? Is it a sort of holistic sign off on what you're doing?
No, so just to be clear, the carbon project is held under our subsidiary Maya Renewables. It's
Yeah.
our commitment that we will utilise those credits when and should they become available to offset the project, and the Camlodoso landowners will get the majority of the benefit for that. However, from an environmental perspective, we have an environmental social impact assessment, an ESHA, that's been developed for this project that's based off environmental permanent environmental management plan and all the safeguards and mechanisms and monitoring, and that regime has already been rolled out. We're doing all that monitoring as we speak at the moment. So there's multiple layers just to the environment, and we're reporting on that well before this CDA requirement.
Okay, brilliant.
Under the Mining Act and Environmental Act, we've got specific requirements that we've continued to meet.
Got it. Okay, so what am I looking at over the next sort of 6 to 12 months in terms of critical milestones? What am I looking for?
You'll be looking for the kilns being manufactured, pre-modularised, etc., and being put on ships or ship, ready to set sail over to PNG. You'll see a large amount of the earthworks that will be expected to be done to essentially welcome and enable the delivery of the kilns and the associated infrastructure. You'll see other milestones will be stage 3 of the wharf being built. So now it can currently receive barges. You will see a stage 3 development that will be a 2-berth facility into 10.5 metres of water that will be able to accept 30 to 40,000 tonne dead weight vessels for international as well as domestic sailing. You'll see roads and bridges and power and water go in and connecting the people and the project to the rest of PNG. And I think that what you will be able to see is as we move forward, we'll be providing the market with a monthly construction update, so that those things that I've just mentioned will become very clear, transparent, and will be held accountable to deliver on time and on budget.
Well, appreciate your time today. Thank you very much.
Thank you so much. Cheers.